What you just saw was not a normal pullback. It wasn't profit-taking, and it wasn't the market calming down. It was a rule change disguised as a price move. In less than a day, the structure of the silver market shifted right as price pushed into territory the paper system could not comfortably tolerate. And if you only watched the chart, you missed the real story. Silver didn't drift higher. It accelerated. Momentum built fast, leverage piled in, and participation expanded exactly the way it always does when a breakout starts to feel real. At the same time, the physical market refused to cooperate. Premiums stayed elevated, inventories didn't suddenly appear. Overseas prices quietly suggested that real metal was worth more than the paper quote most traders were staring at. That's when the switch was flipped. Let me ask you something. When a casino raises table limits in the middle of a hot hand, who is that decision meant to protect, the players or the house? Because what happened here was the financial version of changing the rules while the game was already in motion. Not next month, not after a review, immediately. Timing is the tell. The exchange didn't act during calm conditions. It didn't act after a cool down. It acted precisely when enthusiasm was spreading and when price action threatened to turn uncomfortable. That's not coincidence. That's control. Here's the sequence in plain terms. Futures traders rushed in, leverage amplified the move, the crowd followed momentum, the physical market stayed tight, and right as confidence peaked, the cost of holding the same position suddenly increased. Same exposure as yesterday, fine. But today you need more cash to stay in the game. That one change forces selling, even if nothing real has changed. Futures isn't ownership. It's a balance sheet agreement. If your account doesn't meet the new requirement, there's no debate, no patience, and no waiting for a bounce. Positions are closed. Liquidation is engineered. The first emotion this creates is doubt. Was the breakout fake? Did the move fail? That confusion is not accidental. It's the opening move. And in the next chapter, we're going to expose exactly who this mechanism targets, who it protects, and why this kind of intervention often signals stress, not strength, in the paper system. To see why this move mattered, you have to understand who futures markets truly serve. On the surface, futures are sold as neutral tools for price discovery. In practice, they are balance sheet arenas, and balance sheets are not equal. When margin rules change without warning, the impact is not shared evenly. It is concentrated. Large institutions barely notice. Banks can reshuffle collateral. Market makers can move capital internally. Funds with deep liquidity can post additional margin in minutes without changing their outlook. For them, a margin hike is an annoyance. For smaller participants, it's an existential threat. That's the asymmetry most people miss. When margin requirements rise overnight, the question stops being whether your thesis is right. It becomes whether you can produce cash immediately. If you can't, your broker doesn't care about supply tightness, overseas premiums, or long-term demand. Your position is closed, not because the market proved you wrong, but because the rules changed while you were already in the trade. This is why calling it risk management is misleading. The risk didn't suddenly appear. Volatility didn't surprise anyone. The exchange knew exactly how crowded the trade was and which side depended on leverage. Raising margins at that moment wasn't neutral. It was targeted. The result is forced selling. Forced selling pushes price down. That drop triggers more liquidations. On a chart, it looks like momentum failed. In reality, momentum was interrupted mechanically. The rally didn't exhaust itself, it was cut short. Then psychology takes over. Survivors doubt themselves, observers feel justified staying out. The narrative flips from strength to uncertainty in hours. That emotional shift is not accidental, it's part of the design. Once leveraged participants are flushed, the market becomes thinner, quieter, and easier to manage. And in the next chapter, we're going to strip the emotion away completely and walk through the math behind this move, because when you see the numbers, the structure becomes undeniable. Now let's remove emotion entirely and look at the mechanics, because this is where the story stops sounding controversial and starts sounding mathematical. One standard silver futures contract controls 5,000 ounces. When silver is trading in the mid-80s, that single contract represents more than $400,000 worth of metal. Yet almost no one trading it is putting up that amount of cash. They post margin, a performance bond, collateral meant to cover adverse moves. Under the previous framework, that margin was a fixed dollar amount low enough to allow massive exposure with relatively modest capital. That leverage is what fuels fast rallies, but it's also the pressure point the exchange controls. Now change one variable. Instead of a fixed margin tie the requirement to a percentage of contract value. Overnight, the cost of holding the same position jumps by thousands of dollars per contract. Not gradually, instantly. And that difference has to be wired immediately or positions are closed. Multiply that across accounts holding multiple contracts, and you get a scramble. Selling begins not because traders want out, but because they are forced out. That selling pushes price lower, which increases perceived risk, which triggers more forced exits. It's a feedback loop that feeds on itself. This is why margin changes are so powerful. The exchange doesn't need to create supply. It doesn't need to argue fundamentals. It simply alters the cost of participation until the most price-sensitive players are gone. And once they're gone, the market resets. In the next chapter, we're going to connect this directly to history, because this isn't new. Silver has seen this playbook before, and every time the pattern tells you far more about stress in the system than about weakness in the metal. If you've been around the silver market long enough, this sequence should feel familiar. Price starts to run. Momentum builds. Participation expands. Confidence spreads beyond the core believers. And then, right as the move begins, attracting broader attention, the rules change. Margins rise. Sometimes once, sometimes multiple times in rapid succession, always fast enough to destabilize leverage. This isn't speculation, it's history. Silver has a long record of rallies that didn't end because demand vanished, but because leverage was intentionally flushed. Each time the explanation sounded responsible. Volatility control, market stability, risk management, and each time the outcome was predictable. Leveraged longs were forced out while institutions with deep capital survived the squeeze and repositioned into weakness. That's the reset mechanism. What makes this episode more revealing is the surrounding context. The physical market is not loose. Inventories are not suddenly abundant. Dealer premiums are not collapsing, and overseas pricing continues to suggest that real metal is valued higher than the domestic paper quote. That combination matters because it limits how effective paper pressure can be if it persists too long. When the paper market pushes price down without creating real supply, it doesn't destroy demand. It redistributes exposure. Weak hands exit under stress. Stronger hands step in quietly. The narrative flips from excitement to doubt, which is usually when long-term positioning improves beneath the surface. This is why chart-only analysis fails here. The structure matters more than the candle. And in the next chapter, we're going to zoom in on the growing disconnect between paper pricing and physical reality, because that gap is where the most important signals are forming right now. Now we need to focus on the gap that keeps widening the difference between paper price and physical reality. This is where most people lose clarity because they're trained to believe the number on the screen is the truth. In calm markets, that assumption mostly works. In stressed markets, it fails. When physical silver is truly abundant, premiums collapse quickly. Dealers discount inventory. Supply appears everywhere at once. Delivery becomes easy. None of that is happening. Premiums remain stubborn. Availability stays tight. Lead times don't disappear. And in major overseas venues, silver continues to trade at levels that quietly challenge the domestic paper quote. That behavior is not normal. That's stress in the plumbing. When the same metal carries different prices in different places, the system is signaling friction. Metal is being valued based on access, not theory. And when that friction grows, the role of the paper market shifts. It stops discovering price and starts containing it. This is where margin policy becomes powerful. The exchange doesn't need to create supply or change demand. It simply raises the cost of holding paper exposure until the most price-sensitive participants are pushed out. Once they're gone, pressure eases and order is temporarily restored. But this distinction matters. A dip caused by margin pressure is mechanical. A dip caused by collapsing demand is fundamental. One tells you nothing about the real economy, the other tells you everything. Mixing them up leads to emotional decisions at the worst possible moments. And that brings us to strategy. Because how you respond depends entirely on whether you're playing inside their arena or building exposure outside of it. In the next chapter, we're going to break down that difference and why it determines who survives these moves and who doesn't. This is where strategy stops being theoretical and becomes personal. How you respond to moves like this depends entirely on where you're standing. If you're inside the futures arena, you're playing by rules that can change without notice. If you're outside of it, the same event looks very different. Futures trading is not about conviction. It's about liquidity and compliance. You can be right on fundamentals and still be forced out if you can't meet a sudden cash demand. Margin calls don't ask whether your thesis changed. They ask whether you can wire money immediately. That reality alone is why futures are a place to trade, not a place to build long-term exposure. Physical ownership operates under a different logic. Coins, bars allocated storage, they don't receive margin calls. They don't care about exchange policy memos. A margin hike can influence the headline price, but it cannot force you to sell metal you already own. The only pressure it applies is psychological, and psychology is the real battlefield. Paper-driven dips are designed to shake confidence. Red candles trigger doubt. Headlines reinforce fear. The goal isn't just to move price, it's to move behavior, to get you to sell voluntarily what the system cannot take from you directly. This is why so many people exit hard asset cycles early. Not because the thesis breaks, but because the pressure becomes uncomfortable. The system tests discipline before it rewards patience. In the next chapter, we're going to widen the lens and connect this move to the macro backdrop because this margin action didn't happen in isolation. It happened against a global environment that makes hard assets increasingly difficult to ignore. To understand why this margin move happened, now you have to zoom out. This didn't occur in isolation. It happened against a backdrop of mounting strain where long-standing assumptions about money stability and control are being quietly tested. Debt levels are extreme. The cost of capital is unstable. Policymakers are cornered between inflation and fragility. When pressure builds, the response is predictable: liquidity over pain, support over discipline. And when liquidity enters the system, it doesn't spread evenly. It gravitates toward what is scarce and tangible. That's why hard assets keep resurfacing. Silver is especially uncomfortable for the system because it refuses to behave like a simple financial asset. It's not just a store of value. It's an industrial necessity. It's embedded in electronics, energy infrastructure, and advanced manufacturing. Speculation can be debated, but demand from factories is not optional. That dual role creates tension. Investment demand tightens supply. Industrial demand locks it in place. Paper contracts can multiply endlessly, but physical metal cannot. And when that imbalance grows, price discovery becomes harder to manage. This is when silver stops moving smoothly. It surges, it stalls, it gets interrupted, and when it threatens to act like a scarce commodity instead of a spreadsheet entry, the guardrails appear. The margin hike wasn't random. It arrived as attention increased and narratives turned bullish. That timing reveals concern about what comes next, because no system raises barriers mid-move unless the continuation feels dangerous. In the next chapter, we'll focus on what to watch after the forced selling fades, because the real signal isn't the drop, it's the reaction that follows. This is the moment where most people make the wrong decision because they focus on the candle instead of the response. The forced selling already happened. The margin pressure did its job. Now the question becomes simple. What happens next? Watch the spreads. If overseas premiums reappear or widen after the paper shakeout that tells you physical demand never left. Watch dealer inventory. If availability stays tight and discounts don't show up, the dip didn't create supply. Watch delivery interest. If demand for real metal remains elevated, then the paper drop was just a transfer of exposure. Also watch the narrative. Listen to how quickly confidence collapses in the commentary space. When the same voices that were euphoric at the highs suddenly declare the move over after a mechanically driven dip that's a tell. Narrative is a weapon, and it's most effective when emotions are raw. This phase is designed to test discipline. Red candles create urgency. Silence from institutions creates doubt. The system doesn't need to force everyone out. It only needs enough people to question themselves. If price stabilizes and demand remains firm, the pressure shifts back to the paper side. If price rebounds, the uncomfortable question returns. How many times can the lever be pulled before confidence in the venue itself starts to erode? Because margin policy works, but it has limits. Pull it too often and participation thins. Liquidity migrates. And once control weakens, managing price becomes harder, not easier. In the next chapter, we're going to address the emotional core of this cycle because understanding the structure is important, but surviving it requires something else entirely. This is where the numbers fade and psychology takes over because this cycle doesn't just test capital, it tests conviction. When markets behave this way, people don't just lose money, they lose trust. They start to feel the game is unfair, the rules are unstable, and participation itself is pointless. That feeling is not an accident. Discouragement is a feature of the system. When enough people believe a market is unwinnable, they disengage. They retreat into passive positions. They accept returns that quietly lose to inflation while telling themselves they've chosen safety. Pressure is released without headlines, without reform, and without anyone having to admit the structure is strained. Hard asset cycles don't work like conventional markets. The rules don't remain stable because the system is actively defending itself. When metal starts acting scarce, instead of theoretical intervention appears. And the objective isn't only to move price, it's to exhaust patience and fracture conviction. That's why discipline matters more than prediction. You don't need perfect timing, you need emotional resilience. Discomfort often shows up just before clarity. The best moments to build exposure almost never feel calm or obvious. They feel uncertain, frustrating, and lonely. This isn't blind optimism. Context still matters. A paper-driven sell-off doesn't erase physical demand, and a red candle doesn't create supply, and a policy memo doesn't rewrite reality overnight. Position sizing matters as well. Exposure that lets you stay calm survives cycles. Exposure that keeps you anxious gets abandoned at exactly the wrong moment. The system doesn't exploit ignorance, it exploits impatience. In the final chapter, we're going to bring everything together, the structure, the psychology, and the strategy, and extract the lessons this moment reveals about silver and about how markets truly work. So let's bring this full circle and strip the noise away. The margin hike was not proof that the silver move was wrong. It was evidence that the move mattered. It revealed stress in the paper structure, sensitivity to momentum, and a preference for control over acceptance. Markets don't reach for emergency levers when nothing is happening. They do it when continuation feels threatening. The lesson here isn't about silver alone. It's about how modern markets function. Price is not just discovery, it's governance. When participation grows too fast, when leverage amplifies conviction, and when physical reality refuses to cooperate, the system responds with rule changes instead of debate. That doesn't mean markets are broken. It means they are managed. Your advantage comes from knowing where you're standing. Chori, if you trade, respect the arena. Understand leverage, margin, risk, and timing. Never confuse a paper position with ownership. If you're building long-term exposure, recognize that volatility is part of the process, not a verdict on your thesis. The biggest mistake people make is outsourcing conviction to headlines. A red candle doesn't equal failure. A policy memo doesn't invalidate supply and demand. And discomfort is not the same thing as being wrong. The strategic takeaway is simple. Stay disciplined. Size positions so emotion doesn't control you. Separate mechanical moves from fundamental shifts. Watch premiums availability and real demand instead of chasing narratives built on price alone. Because in every hard asset cycle, the same truth repeats. The moments that feel the most manipulated are often the moments closest to clarity. The system tightens when pressure builds, not when it fades. If this analysis helped you see the structure more clearly, take one simple action. Subscribe to the channel so you stay ahead of the next rule change instead of reacting to it. Share this with someone who still believes markets are always fair. And drop a comment below telling me how you're positioning buyer holder or observer. Stay disciplined, stay patient, and remember, the real story is never just the candle.